Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets and the markets closely related. And there are plenty of things to talk about in this week's nice volatile market environment, are there not, Miles?
Yeah, interesting market. I don't know which one to pick. There's the FOMC today.
Let's start there because that really did have a ripple effect through all markets. That'd be a fun launch point.
It did and it didn't because we got exactly what was expected. I think the whole market was expecting a 3/4 point jump, which is exactly what we saw. And most of the markets had reversed and been climbing a little bit off of that news, gold included. The equities market has been up. Gold jumped up today. So did silver, but so did the stock market. The S&P jumped up a little bit today, still down significantly for the year. But my argument has always been that the emotional reaction to uncertainty in the short term has a greater effect than the actual numbers do, at least again in the short term. In the long term, numbers win. In the short term, reaction wins. So because we got what was expected, we didn't see a dramatic jump today, but like you said, it's been very volatile for the last week.
I think some of the reaction today was a sigh of relief, quite honestly, that it wasn't a full point, because there was a lot of talk. When you had the equities market showing strength, the U.S. dollar index was hanging in there, inflation appears to be topping, gas prices had been coming down along with other commodities, and with employment numbers strong, the way at least that they report them, all of those were sort of green lights, if you will, for the Fed to have a more aggressive hike even than 3/4 of a point. Now the talk is, okay, we're going to stick with 3/4 now. We'll see what September brings. So we get a little bit of a respite in August with no hikes. But if in the short term you focus on what should gold do when the Fed hikes rates, gold should go down. Instead, it went up, I think, because it wasn't as significant as some feared it could be, even though they did what was predicted.
So we're looking at a couple goals here, right? Getting back to 2% inflation. Good luck with that. But how do you do that with already tight labor markets and declining markets across the board from the equities market? Because obviously an equities market that's propped up on borrowed, reinvested money, where's the additional income going to come from in a recessionary-like environment? And we'll talk about the definition of a recession here in a minute, because that's another thing worth, I think, even more fun to go into. So we'll get into that in a second. But in a recessionary-like environment, rising interest rates, where's the money going to come from to keep the housing market afloat? Where's the money going to come from to keep the equities market afloat? Ain't coming from you and me, and it's not like we're sitting on 10% unemployment right now of people that can get back into the workforce and get that money flowing back into the system. So I don't know what the solution to this problem is, except writing it out, because I think the problem is bigger than the White House, at least, is willing to admit.
Well, they're really walking this fine line. I mean, this inflation is created by the Federal Reserve, and now the Federal Reserve is purposefully inducing a recession to fight it. And so how deep does the recession go? And again, let's get into the definitions, because on one hand, they need there to be a recession in order to cool inflation, because certainly they don't want an inflationary recession or depression. They would much rather have a deflationary recession or depression as long as everything stays in check and in control. And that's what I think that they're hoping for. But White House, administration and people in Washington don't want there to be a recession at all on paper. So if they can somehow create a recession.
How do you get reelected during a recession?
That's right. If you can have a recession for the effects of cooling inflation, but not have a recession on paper due to the political sensitivities to that, what do you do, Miles?
You just tell people that it's not a recession. You just completely change the definition. So the White House a couple days ago put out a piece, How Do Economists Determine Whether the Economy is in a Recession? And the solution to the problem is to gaslight 6.5, 7 billion people by just redefining everything. So what is a recession? Well, some maintain that 2 consecutive quarters of falling real GDP constitute a recession, which would be what, say, anybody who's gone to any economic class in any point in the last 50 years would say that's the quickest, easiest sort of snapshot way to define it. Oh, White House continues, that is neither the official definition nor the way economists evaluate the state of a business cycle. So all of those economists that went to college in the last 50 years apparently are wrong, or they're just changing the whole thing. So it kind of fascinates me. It's those same economists that went to college, they probably also read Orwell's 1984, so they understand the value of changing definitions over time. So this is exactly that. What's been one of our biggest complaints in this show and across the board for a long time? Redefining terms. The easiest way to solve a problem is to just redefine the terms so it's not a problem anymore. Rob and I talked about this for the last 3 weeks in here when we were talking about the definition of inflation and how they've changed how inflation is calculated over the last 30, 40 years. Now we're redefining what a recession is. What were you telling me a second ago about Biden's economist?
Oh, yeah. One of President Biden's own White House economic advisors even said back in 2019 that his definition of a recession was when GDP crossed zero, when it turned negative at all for a quarter. So if we do it back-to-back quarters, that all but foments the fact that his theory is intact, and yet he's going to run and hide from that. So the problem with recessions is that you fight them with weaker currencies and declining rates. Never, and it cannot be possible. When you're in an environment of higher rates and a strong currency, you're not going to be able to fight a recession. You have to turn the currency down, which is encouragement for the gold holder, and you have to decrease rates, which means the Fed at some point is going to pivot. So they can say all this. The other issue that you really have, Miles, is that this is a global recessionary issue. The IMF is warning that the global economy is on the brink of recession. And we know that most recessions sort of play out with retrospection, but they're predicting that to be the case here as we go into the fall and into the start of the new year. We're in a global recessionary start off here, and whether the U.S. wants to admit it or not, you can't fight it unless you weaken the currency and you lower rates.
Yeah, you have dramatic problems in the housing market in places like China. We also have a major international crisis taking place in Eastern Europe. So where do we think a lot of the money is coming right now into the U.S. dollar, which is raising interest rates? It is providing a safe haven for international investment coming in. But to what extent and for how long? Because we have our own problems here domestically as well. That's not going to be able to float the entire global economy amidst all the crises taking place.
Well, it doesn't only get more expensive for me, right, or for you, or for any of us.
Like I know you said a second ago, gas is down. It's like, great, to what, $4.70 instead of $5?
But look at what raising interest rates do for the government. I mean, you're sitting on $30.6 trillion in federal debt. And that means that for every 1% increase in rates, the federal debt servicing goes up $27 million per day. So they're not going to leave these rates higher and higher and higher and just climbing in this type of a mode. At some point, they're going to pause and they're going to turn around, they're going to pivot, and they're going to have to start going the other way. But they can't go the other way unless they put these arrows back in the quiver, and that's what we're witnessing. So don't get discouraged that gold is down. Look, the time to buy gold is when it can actually serve as a hedge for you. If you're not acquiring physical gold ounces on these drops, then what are you doing? This is when you purchase and acquire ounces in advance of the next strong inflationary wave or geopolitical turmoil or a switch in monetary policy with easy money and lower interest rates. Now is the time that you add to your ounces. And we're seeing higher lows put in here, are we not? Let's jump into the gold chart here real fast, because last week you put up this really good image of this huge range we're in of around $1,680 to really $2,100. So can we laser focus out a little bit and show us what we're doing here lately?
Sure. So 1682 bounce last week in the London markets, not in the U.S. markets, and we're up to about 1740. So a pretty big jump here over the last week. A good chunk of that did occur today. I think we went up, $25 or so today, but had already reversed. We do have some RSI divergence, looking at the declining price leading into that bottom and rising indicators. So those had diverged against each other, which would make you expect to see a bit of a reversal. Personally, I would like to see gold push into the low 1800s, maybe 1820, 1825. That's going to be your 382 fib on the downside. So looking at where the decline started back in March to where we ended up last week, getting back to the 382 fib at around like 1805-ish, somewhere in that range. I think that's pretty likely on this move, which means we probably have another $60-$70 up over the next week or so. Then we'll have to see what it does from there. I would like to see gold put in a higher high above about 1880. 1880 is kind of my break point to argue that we are going to push up and at least retest that 2100. So I'd like to see a move above 1880. That kind of gets us above the trading range that we were in between May and June before we had this last little drop off at the end of June, putting in the July low and then a reversal back up. So the trading range has been massive, and we've been at the top end twice and we've been at the bottom end now 3 times. So I'd love to see that continue to stay in that range. We've looked at the long-term gold chart going back to 2015 when the bull market actually started, and we're still only at the most shallow potential reversal level. 1685 is not that deep. 1450 is still an aggressively bullish number. So you have to zoom back out and you have to look at the entire market as a whole. I know we want to zero in on the day that we may have made a purchase for whatever reason, but you're picking one tree out of a bigger forest. So you want to make sure you're looking at the whole thing.
So look, this is the environment to be owning gold and or gold equivalent ounces in the form of silver or platinum, because they're both still very undervalued. In fact, the gold to silver ratio got as high as 93 to 1. Now we're back down to 90 to 1 on this recent price action here yesterday and today. Don't be discouraged again by that with silver, because it's screaming to buy silver. Know that, do you want to be trusting people that are sitting there fudging economic numbers in the way that metrics are not only defined but reported? Or do you want to lean on the tried and true 5,000-year-old currency and the hedge that it brings? And when you have these opportunities on these pullbacks, call it manipulation, call it microphone manipulation, call it COMEX manipulation, doesn't matter why you think gold is down. This rally in the U.S. dollar will not last, and it's just relative strength. They've weakened the currency, and now they have 2 months to see how this decision plays out. And my guess is that it's going to play out in the form of a deepening recession, and you have an election coming, and you have a lot of social and political pressures to pivot and reverse course. And that's already starting to happen in the oil and gas area, where the Biden administration now is releasing strategic petroleum reserves to the tune of like 20 million more barrels. When? In September and October. Why? Drive gas prices down right before the elections. Similar things are going to happen with the currency, with inflation, with reversing this recession, and they'll make money easy again for some reason.
Yeah, I like that, Tori. I think what we're looking at here, as you said, is a call to being independent, a call to doing your own research. That was one of the main reasons we started doing this show a number of years ago, is to encourage people not to be reactionary and absolutely not to listen to the gaslighters in Washington, D.C., because you're right, it does sometimes feel like the number one goal of a politician is to serve their own re-election cycle. And one of the best ways to do that is to change the definitions of things that aren't going your direction. And that's exactly what we're seeing. Great, strongest dollar in decades, highest gas price in decades. How do those things correlate? With the strongest dollar in decades, shouldn't gas be like 85 cents a gallon? Like, what am I missing? So shouldn't gold be $300?
It should actually be 3,000, but that's for another show.
Yeah, maybe that is for another show. So yes, independent thinking. Do you want to do your research and take your time to make wise, educated decisions about the balance of your portfolio in a clearly and by definition recessionary environment? Or do we just want to keep hoping for the best and not planning for the worst?
So that'll do it for this week's Golden Rule Radio. As always, thank you for returning and listening. If you like what you heard, hit the subscribe button below or ring the bell. You can also find us on Twitter at ICA Gold or our website, McIlvaney.com. If you would like to walk through your personal portfolio with one of our advisors, you can call us directly at 800-525-9556.
Thanks for listening. Have a great week.